This week, consumer sentiment hit the lowest reading on record going back to 1952. Gas is back over $4 a gallon. The Iran war is now in week 8, and the largest grocery-anchored shopping center REIT in the country reported new lease rent spreads of 36%. If you own a strip center right now, that disconnect is the most important thing happening right now. Let me walk you through it. Before we get started, I wanted to tell you about a new listing we just brought to market. Santa Fe Plaza, located in Converse, Texas. 2020 construction retail strip center comprising of 12,100 square feet on 1.5 acres, offered at a 7.01% cap rate. The property is 100% occupied, 6 tenants, triple net leases, favorable for the landlord, low management responsibilities, staggered expirations and built-in escalations, producing $301,372,000 in NOI, asking $4.3 million. Feel free to reach out. I would love to send you the OM and tell you more about the deal. Let's start with the consumer because this is where the headlines are the ugliest. The University of Michigan released its final April consumer sentiment reading yesterday. The index came in at 49.8. That is the lowest reading on records that go back to 1992. Lower than the 2008 financial crisis, lower than the 2022 inflation peak, lower than COVID. And here's the part that matters most for retail. 1-year inflation expectations jumped from 3.8% in March to 4.7%. That is the largest one-month jump since April 2025. When consumers expect prices to keep rising, they pull back on discretionary spending. They trade down. They eat at home more. They delay big purchases. We are watching that re-anchoring happen in real time. Now, layer on the energy picture. AAA's national average for regular gasoline is sitting at about $4.08 as of this morning. WTI is back near $93. Brent crude topped $106 yesterday as the Strait of Hormuz situation re-escalated. 2 months ago, this looked like a temporary spike, and today it looks like the new baseline households are operating in. And the optical illusion you need to be aware of. March retail sales jumped to 1.7%. Now that sounds great, the biggest monthly jump since January 2023. The Census Bureau report is not adjusted for price changes, and gasoline station receipts surged a record 15.5% for this month. Strip the gas effect out, and the consumer is materially weaker than the headline suggests. Labor market is one bright spot. Initial jobless claims came in at 214,000 for the week ending April 18th. Still inside the historically healthy 200,000 to 250,000 range that we have been in since the pandemic. And the 10-year treasury closed yesterday at 4.3%, with shopping center loan rates starting around 6.32%. Now here's where things get really interesting. On the same day, all the consumer data was hitting the wires. Phillips Edison and Company, the largest publicly traded grocery-anchored shopping center REIT, reported its Q1 2026 results. Quick context for those who don't follow public REITs. Phillips Edison Company owns about 290 grocery-anchored neighborhood centers across 31 states. Their Q1 numbers reported April 23rd, leased portfolio occupancy of 97.1%, inline occupancy of 95%, renewal rent spreads of 21.2%, new lease rent spreads of 36.2%, record high 37.9% rent spread on comparable inline new leases. Now let that sink in. While the consumer sentiment was hitting an all-time low, neighborhood center landlords were releasing space at 37.9% above the prior tenant's rent. That is structural rent growth happening in the same week the headlines were screaming stagflation. Now, being straight with you about what this means and what it doesn't mean, Phillips Edison and Company is a grocery-anchored REIT. Most of our clients own unanchored centers or shadow-anchored centers in Central and South Texas. You are not going to clock identical 36% new lease spreads, but the directional read is real, and it tells you something the headlines won't. The on-the-ground demand for well-located neighborhood retail space is stronger right now than it's been in years. Now, there's 3 reasons for that, all of which compound. 1, there is essentially no new supply. Strip mall construction has been frozen because of high construction costs and elevated interest rates. The product you own is irreplaceable at current rents. Number 2, retail vacancy is sitting near historic lows around 4.5% nationally, and Unanchored strip centers are running about 4.5% vacancy. Tenants who need space are competing for what already exists. And number three, a whole pipeline of expanding tenant categories is chasing the same square footage. CoreSite projects U.S. retailers will close about 7,900 stores in 2026, down 4.5% from 2025, while opening about 5,500. The closures are concentrated in legacy mall-based names, not in the kind of inline space your tenants occupy. So let's get specific about who is actually expanding. If you own a strip center and you are thinking about your next vacant suite, these are the tenant categories your broker should be hunting for. Crunch Fitness alone is targeting more than 100 new openings in 2026. Evan Management reports 40% of their portfolio centers now have a fitness tenant totaling nearly 330,000 square feet. Boutique concepts like Stretch Zone, Hotworks, and pickleball facilities are all chasing space. About 20% of leased medical space is now in retail buildings, up from roughly 16% in 2010. Tenant improvement investments for a medtail build-out often run $200 to $300 a square foot, sometimes higher, which makes these the stickiest leases on your rent roll. Drive-through pad sites and out parcels are still red hot in our markets. Beverage concepts like Seven Brew, Dutch Brothers, and Swig are aggressive on Texas. Chicken concepts and coffee continue to lead unit growth. And if you look at small shop deals that closed in Texas this past quarter, you're going to see the same playbook. Tropical Smoothie, for example, Cold Stone, Five Guys, nail salons, dental, vape, and smoke shops, though those might be a little tricky moving forward. Hotworks, these are the tenants that fill an unanchored center. They are local, services-oriented, internet-resistant, and they save the consumer time. That is the whole pitch of your asset. So the CRE takeaway, Phillips Edison and Company is reporting record-high 37.9% rent spreads on comparable inline new leases. Your in-place rents are very likely below market, particularly if your last leasing cycle predates 2023. You want to pull every lease expiring in the next 24 months, build a market rent comp book for your trade area. Don't sign a renewal at last cycle's rates without understanding what a new tenant would pay. Simon Property Group reported that 38 Saks off fifth leases that were rejected in bankruptcy were re-tenanted at a 67% rent spread, meaning the new tenants are paying 67% more than the old anchor was paying. If you have a struggling anchor or a junior anchor coming up on renewal, don't panic. Model the mark-to-market upside. The tenant pipeline behind a backfill is deeper than it has been in a decade. A vacated 12,000 square foot box might be worth more in year one of a new lease than it was in year 10 of the old one. And although lending rates are elevated, strip center loans are starting around 6.32% with the 10-year at 4.3%. But your NOI growth right now is materially better than what underwriters were modeling 18 months ago. Phillips Edison same center NOI grew 3.5% year over year in Q1, and inline leasing deals are getting average annual rent bumps of 2.7%. Do not anchor your hold sell decision on what cap rates we're doing in 2024. Run the math on your actual asset. If you have inline leases rolling, your forward NOI growth could justify holding, or it could create the cleanest sale moment you've had in years if a buyer is willing to underwrite the rent reset upside. So in close, the macro picture is genuinely difficult right now. Sentiment at an all-time low is not a number you wave away. But the leasing market for well-located neighborhood retail real estate is having one of the strongest moments in years. There is a real disconnect between the macro headlines and what is actually happening in rent rolls of the assets we sell and advise on. Don't let one set of data convince you to ignore the other. Both things are true at the same time. If you're thinking about your hold period, your refi, your tenant mix, or your exit, this is the kind of week where a 30-minute conversation can give you some guidance and help you stay more informed. Reach out anytime. I'm Ray Kang. This has been Retail Weekend Wrap Up. We'll see you next week.